You know what keeps most traders awake at night? It's not the fear of a bad trade. It's not even the sting of a significant loss. It's something far more insidious, something that gnaws at the very core of your confidence as a speculator. It's the maddening inconsistency. One week you're a genius, reading the tape like it's written in your native tongue. The next week, you might as well be throwing darts blindfolded. You make money on Monday, give it all back by Wednesday, and by Friday you're wondering if you ever knew anything about this game at all. I've been there, more times than I care to admit, and certainly more times than the newspapers ever printed. They loved writing about my millions, about the coups, about the times I broke the bears or rode the bulls to fortune. But they never wrote much about the nights I sat alone in my study, staring at my trading journal, trying to understand why I could read the market perfectly for months and then suddenly go stone blind. That inconsistency nearly destroyed me more than once. It wasn't the losses that hurt the most. It was not understanding why I lost. It was the feeling that I was at the mercy of something I couldn't control, couldn't predict, couldn't master. Let me tell you something about this business that nobody wants to hear. The market doesn't care about your winning streak. It doesn't care that you just made $50,000 in a single afternoon or that you've been right 7 times in a row. The market is not your friend, and it's certainly not your enemy. It simply is. It moves according to its own laws, its own rhythms, and if you're going to survive in this game, you need to understand that your consistency problem isn't really about the market at all. It's about you. I learned this lesson the hard way, and I learned it multiple times because I'm stubborn and because some truths are so uncomfortable that we resist them even when they're staring us in the face. The first time I really made money, I was convinced I'd figured it all out. I was young, cocky, and I'd turned a few $100s into thousands through sheer nerve and what I thought was brilliant analysis. Then I lost it all, every penny, and then some. I was wiped out so completely that I had to borrow money for train fare. That should have taught me something permanent, but it didn't. Not really. I made it all back, and more, and then I lost it again. This cycle repeated itself throughout my early years, and each time I told myself I'd learned my lesson, that this time would be different. But here's what I eventually discovered, and this is the key to everything I'm going to tell you today. The consistency problem exists because we're not consistent beings. We're emotional creatures playing an emotional game, and we're doing it in an arena where emotions are the enemy of profit. Every single trade you make is influenced by your state of mind at that moment. Your confidence level, your fear level, whether you had a fight with your spouse that morning or got a good night's sleep, whether you're trading with scared money or house money, whether you just had a big win or a crushing loss. All of these factors bleed into your decision-making, usually without you even realizing it. The market, meanwhile, remains utterly indifferent to your emotional state. It doesn't care if you're confident or scared, well-rested or exhausted, desperate or comfortable. It moves according to the collective actions of millions of participants, each with their own emotions and agendas, creating patterns that are sometimes readable and sometimes utterly opaque. And here's the cruel joke that this business plays on us. The very traits that help you succeed on your best days, the boldness, the willingness to act decisively, the confidence to hold through temporary setbacks, these same traits will destroy you on your worst days when they manifest as recklessness, impulsiveness, and stubborn refusal to admit you're wrong. I spent years trying to eliminate my emotions from trading. I thought if I could just become mechanical, systematic, emotionless, I'd achieve the consistency I was looking for. I created rules for myself, ironclad rules that I swore I'd never break. And you know what happened? I broke them. Not every time, but often enough that they might as well not have existed. I'd break them when I was angry about a loss and wanted revenge on the market. I'd break them when I was overconfident from a winning streak and thought I could see opportunities others couldn't. I'd break them when I was scared and convinced that this time was different, that the old patterns wouldn't hold. The turning point for me came after one of my most spectacular failures. I'd built up a fortune, truly significant money, through patient, disciplined trading. I'd followed my system religiously. I'd waited for the right setups, managed my position sizes carefully, cut my losses quickly, and let my winners run. Everything I did was textbook perfect. And then something shifted inside me. I don't know if it was complacency or if success made me feel invincible, but I started taking liberties with my own rules. Just small ones at first. A position slightly too large, a loss held slightly too long, a trade taken without my usual signals, just on a hunch. These small violations of my discipline didn't hurt me immediately, and that was the problem. In fact, a few of them worked out quite well, which only reinforced my belief that maybe I was beyond my own rules now. Maybe I'd reached a level of intuition where I didn't need such rigid structure anymore. That thinking, that subtle shift from discipline to arrogance, cost me everything I'd built. I didn't lose it all in one dramatic crash. I lost it slowly, through a death by 1,000 cuts, each one a violation of the principles that had made me successful in the first place. When I finally sat down and really analyzed what had happened, I realized that my inconsistency wasn't random at all. There was a pattern to it, and the pattern was psychological. I was most disciplined when I was scared, when I was building back from a loss, when I had something to prove. I was least disciplined when I was comfortable, when I felt like I'd mastered the game, when success came easily. In other words, my worst enemy wasn't the market, it was success itself. Winning made me sloppy. Winning made me overconfident. Winning made me forget that the market can humble anyone at any time. This realization was both devastating and liberating. Devastating because it meant that my consistency problem couldn't be solved simply by finding a better system or learning more about technical analysis or studying market history more carefully. Those things mattered, but they weren't the solution. The solution required something much harder. It required me to become consistent as a person, not just as a trader. It required me to develop the kind of self-awareness and self-control that most people never achieve because most people never have to. They can live their lives riding emotional waves without suffering immediate, quantifiable consequences. But in trading, every emotional indulgence shows up in your account balance. So how do you solve the consistency problem? How do you transform yourself from someone who trades brilliantly one day and terribly the next into someone who can execute at a high level regardless of circumstances? I'll tell you what worked for me, and I'll warn you in advance that you're not going to like it. It's not a secret indicator or a magical pattern. It's not about finding the perfect time frame or the ideal position sizing formula. Those things matter, but they're secondary. The primary solution is brutal in its simplicity and excruciating in its execution. You have to build a system and then you have to follow it with religious devotion, even when, especially when, everything inside you is screaming to do something else. You have to follow it when you're winning and feel invincible. You have to follow it when you're losing and feel like it's broken. You have to follow it when you see what looks like the opportunity of a lifetime that doesn't quite meet your criteria. You have to follow it when you're scared, when you're greedy, when you're bored, when you're excited. You have to follow it until following it becomes more natural than breathing. But here's what nobody tells you about systems. The system itself almost doesn't matter. I've seen traders make money with dozens of different approaches. Trend followers, mean reversion traders, fundamental analysts, pure tape readers. The methodology is less important than the consistency with which you apply it. What matters is that you have a clearly defined approach that gives you an edge, however slight, and that you execute that approach the same way every single time. The edge doesn't have to be huge. In fact, it probably won't be. But if you execute consistently, that small edge compounds over time into something significant. Let me give you an example from my own trading. One of my core principles was to only trade stocks that were in motion, showing clear directional movement. I never wanted to predict a turn. I wanted to see the turn happen and then ride the momentum. This seems simple enough, but implementing it consistently was incredibly difficult. Why? Because the most tempting trades are always the ones where you think you see the turn before it happens. You look at a stock that's been beaten down, and you think you see signs of accumulation. You want to get in early, to buy it before everyone else recognizes what you're seeing. That's your ego talking. That's you wanting to be the genius who called the bottom. My system said, wait. Wait for the confirmation. Wait for the actual move to begin. And waiting cost me opportunities. Or at least, what looked like opportunities. I'd watch stocks start to rally after I'd been studying them, and I'd kick myself for not buying sooner. But here's what I learned over thousands of trades and millions of dollars won and lost. For every one time that jumping the gun would have worked out better, there were 3 or 4 times when waiting for confirmation saved me from a false signal. The consistency of waiting, of following my rule, resulted in a far better long-term outcome than trying to optimize every single trade. This discipline extends to position sizing, which is where most traders destroy their consistency. You need to decide in advance, based on your account size and risk tolerance, how much you're willing to risk on any single trade. Then you need to stick to that number whether you're feeling confident or cautious. Most traders unconsciously vary their position sizes based on their emotional state. After a loss, they trade smaller because they're scared. After a win, they trade bigger because they feel invincible. This guarantees inconsistent results because you're betting big when you might be getting overconfident and reckless, and betting small when you might actually be seeing things more clearly due to heightened caution. I learned to calculate my position size before I ever looked at a specific opportunity. My system was based on risking a fixed percentage of my capital on each trade, with the stop-loss placement determined by market structure rather than by my personal comfort level. This sounds mechanical, and it is, but that's exactly the point. The mechanical nature of the approach removes emotion from the equation. I'm not deciding how much to risk based on how confident I feel about a particular trade. I'm deciding based on what my capital can withstand and what the market structure indicates is a reasonable stop-loss point. But even with a perfect system, there's another layer to the consistency problem that catches everyone eventually. It's the problem of changing market conditions. Markets go through different phases. Trending markets, choppy markets, high volatility periods, low volatility periods, bull markets, bear markets. A system that works brilliantly in one type of market can fail miserably in another. So how do you maintain consistency when the market itself is inconsistent? The answer is that you don't fight the market's nature. You accept it. You build into your system the understanding that there will be periods where your approach works and periods where it doesn't. The key is to recognize these periods as quickly as possible and adjust your exposure accordingly, not your methodology. When the market is favorable to your approach, you trade at full size according to your system. When the market conditions shift and your approach stops working, you reduce your size or step aside completely. You don't change your criteria for entering and exiting trades. You just change how much capital you're deploying. This is where most traders make a fatal mistake. When their approach stops working, they abandon it and go searching for something new. They think the problem is the system when the real problem is the market conditions. They jump from trend following to mean reversion to fundamental analysis to whatever the latest guru is selling, always looking for the holy grail that works in all conditions. Such a thing doesn't exist. What exists is the discipline to recognize when your edge is present and when it's not, and to act accordingly. I went through a phase in my career where I tried to have a system for every market condition. I'd trend follow in trending markets, trade ranges in choppy markets, and so on. It sounds logical, but it was a disaster. Why? Because I was constantly having to decide which system to use, which meant I was constantly second-guessing myself. Was this really a trending market or just a temporary move in a range? Was this chop or was it just a pause in the trend? I'd switch systems at exactly the wrong time, getting chopped up in ranges when I was trying to trend follow, and missing huge moves when I decided the market was range-bound. The solution was simpler and more elegant. I developed one core approach that worked in the market conditions I understood best, and then I simply waited for those conditions to appear. When they weren't present, I did nothing. I sat on my hands. I watched. I studied. I prepared, but I didn't trade. This drove me crazy at first because it felt like I was missing opportunities. Everyone else was making money while I sat there doing nothing. But over time, I realized that doing nothing when conditions weren't right was just as important as trading aggressively when they were. The money I didn't lose during unfavorable periods was just as valuable as the money I made during favorable ones. This brings me to what might be the most important insight about consistency that I can share. Consistency doesn't mean trading every day. It doesn't mean always being in the market. Consistency means always following the same decision-making process, and sometimes that process leads to the decision not to trade. The amateur thinks consistency means constant activity. The professional knows that consistency means constant adherence to principles, which often requires tremendous patience and inactivity. I remember a period in my career where I didn't make a significant trade for months. Months. My friends thought I'd lost my nerve. They'd see me at the club and ask if I'd given up speculation. But I hadn't lost my nerve and I hadn't given up. I was simply waiting. The market wasn't setting up in ways that fit my approach, so I did nothing. Then, when the conditions finally aligned, I went in big. That one trade made more money than I would have made in a year of constantly taking marginal opportunities that didn't quite fit my criteria. This is what separates the consistent trader from the inconsistent one. The inconsistent trader feels compelled to always be doing something, to always have a position, to always be in the action. They're afraid of missing out, afraid of being on the sidelines when the market makes a big move, so they force trades that don't really meet their criteria. They talk themselves into opportunities that are second-rate. They gradually lower their standards until they're not really following any system at all. They're just gambling, reacting to every wiggle in the market, and then wondering why their results are so unpredictable. The consistent trader, on the other hand, has the discipline to wait, not just to wait for the right opportunities, but to wait through the periods where their approach isn't working, to wait through the losing streaks that are an inevitable part of any system, to wait while others are making money doing things that look tempting but don't fit their methodology. This waiting is active, not passive. You're studying the market, preparing for the next opportunity, maintaining your skills and your edge. But you're not pulling the trigger until all the pieces align. Now, let me tell you about the final piece of the consistency puzzle, the piece that took me the longest to understand and the hardest to implement. It's about state management. Not market state, but your personal state. Because here's the brutal truth that nobody in this business wants to acknowledge. You can have the best system in the world. You can have iron discipline about following it, and you can still fail if you don't manage your own psychological state. I learned this lesson during what should have been one of my greatest periods. I'd built my capital back after a significant loss. I had a proven system that I trusted. I was following it religiously. But I was also exhausted, not physically tired, though that was part of it. I was mentally and emotionally depleted from years of intense focus and pressure. I'd push through it because that's what you do, right? You push through. You don't give up. You keep grinding. And for a while it worked. I was still making money. But the quality of my decision-making was declining in ways that were too subtle to notice day to day. I was slower to recognize opportunities. I was less creative in my position management. I was more likely to make small errors in my calculations or my timing. None of these things were catastrophic on their own, but they added up. My edge was eroding not because my system had stopped working, but because I wasn't executing it at the level it required. It's like asking a world-class pianist to perform a complex piece when they're exhausted. They might hit all the right notes, but the music won't be the same. Trading is the same way. The mechanics might be there, but if your mind isn't sharp, you'll underperform. The solution was something that felt completely counterintuitive. I needed to trade less. Not because the opportunities weren't there, but because I needed to preserve my mental capital just as carefully as I preserved my financial capital. I started treating my mental state as a resource that could be depleted and needed to be replenished. After intense trading periods, I deliberately stepped back, even if conditions remained favorable. I'd spend time away from the tape, away from the quotes, away from the market entirely. I'd let my mind recover. This was incredibly difficult because it went against every instinct I had. When you're in a good streak, when everything is working, the natural impulse is to push harder, to maximize the opportunity. But I learned that pushing too hard when things are going well is just as dangerous as pushing too hard when things are going poorly. In both cases, you're operating from a compromised mental state. When things are going poorly, you're trading from fear or desperation or a need to prove yourself. When things are going well, you're trading from overconfidence or greed or a sense of invincibility. Neither state produces optimal decision-making. The most consistent periods of my career came when I learned to trade from a state of calm, focused attention. Not excited, not scared, just present and engaged with what the market was actually showing me. This state is incredibly difficult to maintain because it requires you to be passionate enough about trading to dedicate yourself to it completely, while simultaneously being detached enough not to care too much about any single outcome. It's a paradox, but it's a necessary one. Here's how I managed it practically. I developed routines that helped me get into the right state before trading. I'd review my rules. I'd remind myself of my long-term goals. I'd consciously let go of my attachment to the outcome of any particular trade. I treated each trade as an experiment, a test of my hypothesis about what the market was doing. Some experiments work, some don't, but each one provides information. This framing helped me detach from the emotional roller coaster of wins and losses. I also developed the discipline to recognize when I wasn't in the right state, and to step away rather than force it. If I was angry, I didn't trade. If I was overly excited, I didn't trade. If I was distracted by personal problems, I didn't trade. This sounds obvious, but it's incredibly hard to implement because there are always seemingly good reasons to trade anyway. The opportunity looks too good to pass up. You don't want to miss the move. You need to make back yesterday's losses. These are all your emotions talking, not your rational mind. The truth is, there will always be another opportunity. Always. The market has been here for hundreds of years, and it will be here for hundreds more. Missing one trade, or one day, or even 1 month, is meaningless in the context of a career. What's not meaningless is the cumulative damage you do to your account and your psyche when you trade from the wrong state. Those losses don't just cost you money. They cost you confidence. They make you question your system. They start the negative spiral that leads to inconsistency. So here's what I want you to understand, and this is the culmination of everything I've learned through decades in this brutal, beautiful business. Consistency in trading isn't about finding the perfect indicator or the ultimate strategy. It's about becoming a person who can maintain high-level performance regardless of external circumstances. It's about building systems and then having the discipline to follow them. It's about managing your position sizes so that no single trade can derail you emotionally or financially. It's about recognizing favorable conditions and being aggressive, while also recognizing unfavorable conditions and having the courage to do nothing. And it's about managing your own psychological state with the same care and attention you give to managing your trades. Every single day in this business is a test of your character. The market is always trying to find your weaknesses, to exploit your biases, to trigger your emotions. It's not doing this maliciously, it's just the nature of the game. The crowd is always wrong at the extremes, and if you're part of the crowd emotionally, you'll be wrong with them. The way you separate yourself from the crowd isn't by being smarter or having better information. It's by being more disciplined, more patient, more consistent. I've made millions and lost millions multiple times over. I've been lauded as a genius and dismissed as a fool, sometimes in the same week. I've felt the intoxication of being right in a big way and the devastation of being spectacularly wrong. Through all of it, the lesson that keeps coming back is this. The trader who can stay in the game long enough, who can maintain their discipline through wins and losses, who can keep executing their system without letting their emotions hijack their decision-making, that trader will eventually succeed. Not because they're lucky or gifted, but because they've mastered the most difficult opponent they'll ever face, themselves. The consistency problem isn't really a trading problem. It's a human problem. We're inconsistent because we're emotional, because we're influenced by recent events, because we confuse activity with progress, because we can't stand to be wrong, because we're too eager to be right. Solving the consistency problem means solving these human problems, and that's the work of a lifetime. But if you're serious about this business, if you really want to succeed, that's the work you have to do. So I'll leave you with this challenge. Stop looking for the next great strategy. Stop searching for the secret indicator. Stop thinking that if you just find the right system, all your problems will be solved. Instead, look at yourself. Look at your trading journal and identify the patterns. When do you trade your best? When do you trade your worst? What emotional state produces your best decisions? What emotional state leads you astray? Build your system around your strengths and build safeguards against your weaknesses. And then, day after day, trade after trade, execute that system with unwavering discipline. Not because it will always work. It won't. Not because you'll never have losing streaks, you will, but because consistent execution of a sound system is the only reliable path to long-term success in this business. Everything else is just noise. The market will be here tomorrow, and the day after, and the day after that. Your job isn't to catch every move, or to always be right. Your job is to be consistent enough, disciplined enough, and patient enough to still be in the game when the big opportunities arrive. That's how you build a fortune. That's how you become a professional. That's how you solve the consistency problem. Now, if this resonates with you, if you're ready to stop making the same mistakes and start building real consistency in your trading, I want to hear from you. Drop a comment below telling me your biggest consistency challenge. What part of your trading gives you the most trouble? Is it sticking to your stops, managing position sizes, trading too frequently, being too patient? Let's talk about it. And if you want more insights like this, more lessons from the trenches of speculation, make sure you're watching the other videos on this channel. I've spent a lifetime learning these lessons the hard way, so you don't have to. The knowledge is here. The question is whether you have the discipline to apply it. Remember, in this business, you don't get what you deserve. You get what you consistently execute. Make your execution worthy of your ambitions.